All right, welcome to the April 2025 market update. I'm super excited to have my friend and colleague Josh Fischer here with me. Josh, how's it going today?
Great, Andrew. Thanks for having me. How are you?
Doing great.
Awesome.
So, there's a lot of talk right now about what's happening in the market. So, I thought it'd be good to just hop on and talk a little bit about what we're seeing. Obviously, one of the most timely things right now that folks are talking about is tariffs. So
Yep.
I'd be really curious to hear your perspective on tariffs. What are you seeing in the market? Particularly, I guess, what are you seeing as it relates to our markets and our investment strategy?
For sure. Yeah, it's super timely. It's kind of all anybody wants to talk about. As I'm on the phone with individual LPs that we have, everybody wants to know our take on tariffs. So something that I've been thinking about for quite a while, as it relates to what we do, workforce housing in the heartland of America in particular, is this concept of anti-fragility. So there's a thinker and an investor named Nassim Taleb who most people have heard of the concept of a black swan. But a lesser known concept that he came up with is something called the anti-fragility. So there's fragility. So these are things that are really negatively affected by economic shocks or volatility. Then there's the robust or the resilient. So things that just withstand volatility. But then he has a concept called the anti-fragile. So what are things that actually benefit from systemic shocks or from volatility introduced into the system? And his hedge fund, which was called Empirica Capital, they took a very quantitative approach to that. 90% of the wealth in T-bills, and then 10% in really complex call and put options, most of which would kind of expire worthless. But when there are big shocks, they would have huge outsized returns. I think anti-fragility can be applied to our asset class of workforce housing in the heartland of America. So what do I mean by that? I think when you look at our asset class, we actually gain strength from disorder as opposed to weakening from it or just kind of withstanding it. So look at tariffs as an example. So what do tariffs actually do? They're going to encourage businesses to reconsider supply chains, which there's pressure on reshoring, right? Everybody's talking about our supply chain is going to come back to the United States. So what does that do for workforce in the heartland? Well, there's increased pressure on demand, given that reshoring kind of bolsters the American workforce.
Mm-hmm.
And then there's the question: what if that puts downward pressure on purchasing power? Well, that hurts discretionary spending, but for a core asset class like housing and kind of Class B housing in particular, it actually increases demand. The kind of thing that we invest in is the sort of thing that people downsize to as they're looking at their personal P&Ls. The workforce, it's not a population that's going to be homeless if there's a big shock, right? They're going to look at how do we tighten the budget. Housing is kind of the biggest line item on most people's budget, and folks are generally going to look at right sizing that to the kind of affordable quality product that we invest in. I think as I've been kicking this around and thinking about tariffs, I think it's really kind of a unique and really helpful lens to look at this concept of anti-fragility for our asset class. And I think it applies really strongly to the environment that we're in right now. So we're seeing opportunity where others see risk.
Okay. Yeah, really interesting. And super helpful just kind of hear this concept of anti-fragility through the lens of these tariffs and real estate investing. Can you talk a little bit about inflation? And I'm happy to share my thoughts as well, but particularly some of the tariffs could obviously cause inflation. I think that's a natural trend, and
Yep.
there's this term stagflation, which is
Right.
stagnant economy in light of inflation. So I guess I'd be curious, what are your thoughts on consumer spending and how that might be impacted by some of the dynamics related to tariffs?
Yeah, for sure. It's on a lot of people's minds. Stagflation is kind of the vocab word that's being thrown around in investment circles right now. And I think sort of similar story for our asset class. If there's a stagflationary environment where wages are kind of stagnant, but prices are rising, people generally look to cut back on more discretionary type spending categories. So, the entertainment sector could be affected, restaurants and that sort of sector could be affected. In the real estate space, Class A tends to suffer in those kinds of environments because they're pushing the margin of rents, and people are generally looking for ways to contract personal spending. So similarly, while it puts pressure on consumer balance sheets, our asset class tends to do really well and borderline even improve in that kind of an environment because housing is such a core need. And when you look at housing that is well maintained, solid, stable, not the super high end, but conversely not the super low end, tends to benefit in those kinds of environments. So that's how we think about it in terms of how it applies to our business and our portfolio. Andrew, I'm curious to turn the question back to you. What are you thinking about with tariffs, inflation, and this sort of stagflation question?
Yeah, no, it's a great question. I mean, I think as I think of inflation, I tend to think that real estate is a good place to be in inflationary environments. Now, obviously, I'm biased, right? You and I are both biased on this,
Sure.
but if you just look at what's happening to the P&L of a real estate investment during inflation, I think often income is going up because rents are increasing.
Right.
So in an inflationary environment, you would expect rents to increase. Now, what you don't want to happen is that expenses are increasing at the same rate that income is. Now, expenses have increased. We've certainly felt it across certain line items in the P&L, like insurance.
Mm-hmm.
Even labor has gone up. And I think the big thing you want to be paying attention to on the P&L as it relates to inflation is construction costs.
Right.
Now, in our strategy, as you know, Josh, we tend to do what I would call maybe light value add. We're buying units, maybe 70K a unit, adding 7,000 a unit, and worth 90K a unit or something afterwards. So
Right.
that's our typical kind of play. So I do think if you're in the construction, particularly in the development world, construction costs could be increasing with these tariffs, as the reality is most of our stuff is sourced offshore today. I mean, that's just,
Right.
It's the reality of tariffs. It's just going to have a near-term increase until the domestic economy can catch up and we start manufacturing that stuff locally. And obviously that's the hope and that's the reason for the tariffs. But there's just going to be a little bit of a delay there. So that's how I think of it, is just what's impacted on the P&L in an
Right.
inflationary environment. I think rents should be going up. And if you can keep expenses the same, then net operating income goes up,
Right.
which should produce more valuable assets. I think there's a question of, will cap rates adjust?
Sure.
And I think they could. But this better than I do, Josh. I mean, we haven't seen a ton of movement in cap rates based on interest rates moving, based on inflation, at least not in our markets where we're investing. We're just not seeing a ton of cap rate movement. It seems like cap rates have sort of stabilized, at least where they are today. So I'd be curious to hear, from you, what are you seeing out there as it relates to cap rates?
Yeah, agreed. In our space, in an inflationary environment where folks are sort of expecting to be able to juice NOI as a result of rents moving upward, the cap rate really just becomes a less important metric when evaluating a real estate opportunity, because the stream of income is viewed as less stable, right? If folks are underwriting sort of across the board upside over the hold period of an investment, you're just more focused on IRR as opposed to the going in cap rate, because it's a less stabilized stream of income. That's certainly how we're underwriting as buyers. In place income and in place NOI, certainly something that's important to pay attention to. But if we're coming in with a strategy where we're expecting to boost rents by 20% in the first 18 months of our hold period, the going in cap rate is just a less relevant metric. And that's what we're seeing as a seller as well. We're much more oriented towards a story around upside as opposed to current cash flow, which just sort of takes some pressure off of the cap rate as a metric. And the other thing that I was thinking about as you were discussing the P&L, of a real estate investment in an inflationary environment, again, we're certainly biased. We're primarily multifamily investors, but what I love about multifamily is we're generally looking at a 1-year lease, so we can just be a lot more agile in reacting to what the broader markets are doing in terms of the property markets. If rents are really spiking in a micro market, we can generally turn over our entire P&L from a top line standpoint within 12 months, as opposed to other asset classes, like office or retail, where folks are signing 5, 7, 10-year leases. There's just a lot less of an ability for owners and asset managers to be agile and react to economic environments that change the stream of income kind of quickly in real time. It might take a retail, an industrial, an office owner 10 years to have their income reflect a new supply demand environment, whereas we can just react a lot more quickly.
Interesting. Yeah, it makes sense. Given the 1-year leases, so folks who are locked in those longer leases are obviously going to maybe be impacted a little bit more. That's a good point. I'm curious, is it changing how you're underwriting deals at all? Like obviously it's very new. I think they just went into effect, last week.
Sure.
So are you thinking about underwriting differently at all?
Yeah, it's a great question. I think what it does is introduce a bit of uncertainty. So, in climates that are more economically stable, buyer and seller kind of know what to expect in terms of top line rent growth. You're underwriting to more of a traditional 2 to 3% organic rent increase. Now folks on the sell side are trying to sell a story that rents should outpace traditional growth indicators, because of course they're able to get more for their assets if folks are underwriting higher organic growth. But again, in our markets, we tend to be more insulated from that kind of thing. Where the Sun Belt, folks really are getting their deals to pencil by looking at really significant year-over-year organic rent growth. The story for us in the Heartland, we certainly look at the data, we look at what economists are projecting, but it's really difficult to get us to be interested in underwriting really more than 4% year-over-year growth, and usually that's just kind of in the first 12 months. We tend to be more stable, and the sell side community really tends to understand that as well. Where the Sun Belt, folks just tend to get more aggressive on what they're doing in terms of year-over-year organic rent growth, which certainly works for some folks. We tend to like to underwrite forced appreciation. So we're just always going to be more focused on what are we doing to actually improve the asset? Are we eking out any managerial efficiencies through economies of scale? Are we doing, as you said, $7,000 a unit in upgrades to a $70,000 basis? And we're evaluating the new deal in light of the competitive set with those upgrades. We're just always more focused on the things that we can control, because we are an economy that's just more insulated from the broader economic shocks.
Mm-hmm. Yep. Makes sense. Well, speaking of some of the broader economic shocks, obviously not everybody is feeling great about the current status of the economy. Stock market has taken a big hit over the past week or so. The market futures are getting pounded with the announcement of the tariffs. There's been a little bit of a recovery there, but definitely still feeling some of those shocks. Let's just talk outside of tariffs. What are you seeing that's happening in the Heartland? What are you seeing that's happening nationally? Like what's your perspective on sort of the broader economy?
Yeah, for sure. And curious to get your perspective on the same question, Andrew. But, the story that we always tell is in our part of the world, Pittsburgh is where we sit, but we invest in the Heartland and the Midwest in particular. Kind of the name of the game is stability over cycles. The joke that we always make on LP calls and calls with prospective investors is we don't get the hangover because we weren't invited to the party. So we don't have these wild swings upward during boom cycles where there's a ton of new construction, borderline overbuilding. So whenever things tighten or even contract, we're not doing this on the back end. It's kind of slow and steady up and to the right. So as folks are asking me the question, what's going on in your part of the world right now in real estate in the Heartland, kind of my tongue-in-cheek response is, what's going on now is what's always going on. It's just slow and steady up and to the right, as opposed to big swings upward and big swings downward. What about from your perspective, Andrew?
I think that's totally true. I mean, one of the things that, well, let's talk about the national market sort of contrasting to our markets. One of the things that's interesting about our markets is what I would call absolute affordability, which I think does create some built-in downside protection. So, a lot of our markets, the residents are spending 20% of their income on housing, whereas the national average is 30%, even 40% in some other markets. Miami, folks are spending a big chunk of their income on housing. And so,
Right.
one of the things that we think about a lot is we're buying substantially below replacement costs. So, below $100,000 a unit. And one of the things that I think is a concern nationally, and something that we're seeing a lot of talk about is, to build a new unit, it's going to cost you $200,000 to $300,000 per unit. And those costs are just going to go up. We talked about some of the rising construction costs. And so one of the things we think about a lot is just absolute affordability in terms of buying way below replacement cost, and how that translates into being able to rent a unit to somebody that's a relatively small portion of their total income. So I think about that a lot, particularly in the markets that we invest in. Yeah, we love Pittsburgh, Cincinnati, Buffalo, Cleveland, Indianapolis, these markets where you've just seen them slow and steady, up and to the right, just like you said. I mean, here in Pittsburgh, we love markets that are undergirded by what we call the meds and the eds. You've seen Pitt and CMU, and now even West Virginia University just opened a huge medical facility in South Point Business Park, 90,000 square foot facility. So where you're seeing, office get crushed nationally, you're seeing some stability and even some growth in certain markets here in the heartland and in the Rust Belt of the United States. So I've been really excited to see those trends.
Yeah, no question. It's interesting you mentioned, percentage of household income spent on rent. Just anecdotally, we have a property under contract right now with a fairly heavy value add business plan that we're underwriting. $10,000 to $15,000 a unit invested in upgrading the physical property and the units, which is on the heavier end for us. We're actually underwriting our post renovation rents to still 20% of AMI, area median income. So. Even after underwriting a significant lift, we're still just so affordable as a component of people's household P&Ls. So, you're preaching to the choir on that one, Andrew. It's a core part of the thesis and how we look at deals. So I'm interested. You got into office a bit there in the answer to that question. Talk me through other asset classes that we're seeing and what you're seeing go on in our markets and related to the what's going on in the national scene.
Yeah, absolutely. Well, office is like a bad word right now nationally. Right. Nobody wants to talk about it. Everybody hopes, for a miracle. I think in Pittsburgh and in the markets that we invest in, you're almost seeing this like tale of two markets. So, downtown CBD Pittsburgh is 21.8% vacant, and that's an issue for sure. That's where it was at the end of 2024. But if you think about it, even pre-pandemic, downtown Pittsburgh CBD was 15.9% vacant. So it's certainly increased, but it's not all bad. And the reason for that is because there's this what's called flight to quality. You hear people talking about a flight to quality. Class A office is actually seeing increases in occupancy. And one of the things we've just seen here in Pittsburgh, there's this First National Bank building that went up. And I remember looking at this new construction going up, and I'm like, "Oh, that is bad timing."
Right.
What are they going to do? But the crazy thing is, the F&B financial center is actually over 70% pre-leased right now.
Wow.
Yeah, over 14,000 square feet of net absorption there. And so you're seeing folks moving to that Class A occupancy, Class A space, and you are seeing people moving out of the Class B, Class C buildings. There's some substantial vacancy there. I definitely am bearish as it relates to occupancy for those kinds of assets. But we're even seeing rents tick up in office, so I think that there
Mhm.
is some hope there. I think as folks are wanting these more highly amenitized, higher quality spaces, you're actually seeing people being willing to pay for them. So
Mhm.
so I think that provides a little bit of a silver lining in an otherwise bleak picture.
Makes total sense. And what about what are you seeing in terms of what tech is doing in our markets? Is it still a key driver? Has it cooled off at all?
Yeah, it's a great question. I think tech is one of the things that, particularly in some of the markets we're investing in, is a key driver to the economic engine of bringing jobs in particular,
Mhm.
but also bringing investment in. There's a healthcare AI startup that just got valued over $1 billion here called a Bridge. Gecko Robotics, right here on the north side of Pittsburgh where we are, secured a decent round of funding and continuing to grow and add jobs. So I think the markets where, if you just look at the trends, you've got the meds and the eds, right? So folks are coming out educated of
Mhm.
college, and that's actually creating this technology and the startup culture that I think is starting to actually create some of the lift from a jobs perspective, and moving, folks moving to Pittsburgh and areas like ours. And I think that's different than what it was 20 years ago. 20 years ago, I remember when I got out of college, it was everybody was talking about the brain drain. It
Brain
was like,
drain. There it
yeah,
is.
people would come here, get educated, and leave. And I think it's just different now. There's companies that are keeping jobs here in Pittsburgh and other markets like ours that are really helping to improve the economy.
It makes a ton of sense. And one of the other things that if we zoom out to look at the macro picture, everybody knows that COVID has driven some migration to some of the warmer parts of the country as work for home has gotten more prevalent. But maybe a less talked about macro demographic trend is actually a move in knowledge workers to our part of the country because of the affordability, right?
Mm.
Like the absolute affordability and the cost of living. Pittsburgh always wins that award, America's most livable city. The quality of life that you can have, and your expenses as a reflection of your income or as a percentage of your income are just much lower relative to those coastal markets. So, folks that value sunshine are certainly moving south. But for folks that have a work from home setup and are just looking for a more affordable place to raise a family, we are actually seeing some net in migration from the work from home population moving to our parts of the country in a search for more affordable living situation, which is again, as you said, really a new dynamic and certainly some tailwinds for our part of the country.
Yeah, yeah, it makes a ton of sense, and I do think that, um, you know, I don't know how. I feel like I'm going to take a tangent here. I don't know how far off we want to go from the market update, but the reality too is, I think climate change is playing a role in that as well.
Right.
Um, as folks are just continuing to get concerned around global warming and climate change, I think folks are moving. You're starting to see moving away from some of the places where folks were historically flocking to. The warmer areas of our country and the coastal areas of our country, and I think you're starting to see folks that actually want to have the four seasons and want to have a little bit more of a moderate temperature. Natural disasters have certainly played a role in that as well, with the wildfires and hurricanes and things like that as well.
Yeah, no question. And back to kind of the real estate P&L, certainly we've seen some movement in the insurance line item, but folks in Florida are seeing a lot of movement in the
Yeah.
insurance line item. And even some pullback on credit as a kind of a result of the uncertainty related to some of the climate change factors. Are you willing to extend 30-year credit if you're concerned that the investment's going to be underwater in 20 years is kind of
Right.
becoming more of an open question. So yeah, certainly a part of the conversation that we're having with LPs is, we're insulated from economic shocks, but we're also more insulated from Mother Nature than the Sun Belt in a lot of ways.
Yeah.
Andrew, oh please, Andrew, go ahead.
I was just gonna say also California, a ton of friends out in California that are talking
Right.
about not only is insurance going up, but now it's a question of like if you can get insurance. I mean, there's insurance carriers just moving out of California.
Right.
And I think that's going to continue to create a problem, not just on the P&L, but really on the like obsolescence of certain assets in, certain markets.
We're not smart enough to figure that out. I'm certainly glad that we're not in those markets.
Yeah, exactly.
Andrew, talk to me about industrial. What are you seeing in the industrial sector?
Yeah, industrial is one of the sectors that we're seeing tons of growth. If you just look at what's happening here in Pittsburgh, for example, Amazon is driving a lot of the activity with opening a brand new facility right out near the airport. Over 70,000 square feet were delivered to really support some of the logistics stuff we're seeing. Industrial just continues to have steady demand. We're seeing our market holding steady, actually outperforming the national average, just in terms of building new industrial, and also the rents continue to go up. 5%, 6% year-over-year increases is pretty common in that area, and we're continuing to see just a nice supply pipeline. We're not seeing oversupply. Some areas, I think they're just throwing up industrial facilities and kind of doing it on a speculative basis. We're just seeing more of a slow and steady markets like Columbus in particular. You're just seeing some of those issues and some of the oversupply things that we're just making sure that we want to keep building at a pace that makes sense based on absorption.
Makes total sense. And what about retail? Lastly, we haven't really touched much on that yet.
Yeah, retail is really interesting. In the age of e-commerce, like I just talked about Amazon, I did it briefly, but I'm one of those people, like if Amazon packages aren't showing up at my house every day, I get nervous. I'm like,
right.
Where's my Amazon person? I can't imagine life before Amazon. It's wild to think about. And it's gotten even crazier. Like last night, I'm with my daughter and she wanted a book. And I'm like, yeah, we can get you that book. So I'm reading her a book at 9:30 p.m. last night, and she wants a book. It's coming today, like literally next day. I ordered at 9:30 p.m. It was less than $5 with no paying of shipping.
Right.
Like, I just don't know how it works.
Right.
But the reality is that's why industrial is doing well. They're building all these facilities to make the logistics work. But I fully expected that to have a huge impact on retail. I'm like, well, people aren't going to go to the typical bricks and mortar when stuff can just show up at your house. But actually, retail's doing fine. Now, it's a certain kind of retail that's really driving the activity, and that's the service-oriented retail, the entertainment-oriented retail. We're actually seeing rents climbing in some of those neighborhood retail, grocery anchored retail centers. And so I'm seeing a lot of positivity. Just one other anecdote from my perspective. I think that stuff's not going away. As I look at, I do a daddy-daughter date with each of my daughters once a month. And I always want to take my daughter somewhere where there's like a ton of that service-oriented entertainment retail. So just last month, I take my daughter to the Strip District, and you can do indoor miniature golf, virtual reality, and get an ice cream cone, like all in the same building. I mean, it's just crazy. And
yeah,
I think there's just demand for that. I think that demand's not going to go away. Of course, the big box retail, that competes with Amazon is going to get hit. But, that actually, I think, is often offset by some of the service-oriented retail.
Yeah, no question. I think you hit the nail on the head. I worked in retail in sort of a past life, and the phrase that was thrown around was experiential retail, right? Like
Mm,
nobody's that interested in um, going out and shopping for commodities, but people are always going to want to get out of the house, right?
yeah.
So the most cutting edge retailers are adapting to that trend, and it's no longer just go buy a pair of hiking shoes. It's try on the new shoes on our rock wall that's in our facility at REI. It's
Yeah.
creating an experience that's getting folks out of the house and bringing people together. Because you're right, we're in the same Amazon box per day situation that you guys are. We haven't bought paper towels at a grocery store in probably 5 years at this point, but we still want to get out of the house.
Yeah.
And as we at Birgo used to invest in retail before really niching down into multifamily, we would look at a rent roll and just say, does this compete with Amazon? And
Mm,
if the answer was meaningfully yes, we were pretty skeptical about that investment. But if you're underwriting even an unanchored small strip and you're seeing, a nail salon, a daycare, a Thai restaurant, that's pretty safe. People still need daycare and Thai food. So,
always need
yeah,
Thai food.
always need Thai food. Andrew, anything else on your end?
I was going to give a minute if anybody online, we're live streaming this on LinkedIn, Facebook, and YouTube. If anybody online has any questions or comments, you can go ahead and post those in whatever medium you're joining us on, and we'll be happy to answer any of those questions. So maybe just give them a minute if anybody has a question that they wanna share. I mean, just as we wrap up, I think I'm looking into 2025 and 2026, and just looking at some of the major events happening. So, the NFL draft is coming to Pittsburgh next year, and I'm already hearing talk about getting the city ready for that,
Right.
which is really interesting. And the airport modernization is well underway here in Pittsburgh as well. $1.6 billion they're investing into the airport, which I hope allows me to do a better job of getting all my flights on time. But we'll see. And then I'm also seeing some capital invested into the downtown central business district. So we talked about a flight out of those B class and C class office buildings downtown. We're actually seeing some folks converting those to apartment buildings. So that's been
Hmm.
kind of the trend, and $600 million invested in some of those projects downtown. So I think if you take all that into consideration, even with some of the negativity around office, and again, I mentioned I'm kind of bearish on that. There is still a lot of hope and a lot of capital being invested into some of these projects that I think could fare well as we look into this year and into next year.
Yeah, no question.
Yeah. Anything from you? Any concluding comments?
Yeah, again, I just I'm always encouraged by the resilience and again, even the anti fragility of our asset class. I a line that I often come back to as I have individual discussions with our limited partners is we're really buying one of the safest asset classes that you can buy in one of the safest parts of the country in which you can buy it. So, when other folks are kind of obsessively asking this question, like what's going to happen, folks that are more invested on the extremes, we just kind of don't have to be as focused on that question because sort of no matter what happens, we're really well positioned to benefit. During COVID, sort of the one shock that we thought could disrupt our workforce is resilient thesis because a lot of our renters can't work from home. Our collections went up during COVID against our budget. So I'm encouraged by the resilience of our asset class. I'm certainly grateful that the Fisher family balance sheet is personally overweighted to our own products, and we're just feeling really good going into an uncertain climate.
Yeah. Awesome. Well, overweighted is probably an understatement for my exposure to our asset class. So I'm right there with you. We're gonna sink or swim together, but got a lot of optimism about the coming years. So thanks, Josh. It was fun to talk to you a little bit about what's happening in the market. Thanks for your insights and your wisdom. And thanks everybody for joining online. We'll catch you all next time.
Thanks, Andrew. Thanks, everyone.